Hi, everyone. It's John Pocoroba. It's time for a general market update. It's August 26th, 2022. Just a reminder, this presentation is by Rain King LLC, and I'm a amateur individual growth stock investor and not affiliated with IBD. So the agenda for this meetup here is we're going to talk about the market really quickly, an overview, going to get into a few internals, talk about some groups. Again, look at the premise. Is this a bear market rally? Is it a new bull market? And follow up on something I started about a week ago about type 1 and type 2 watch list names as we this latest rally. So the current market, really big picture, weekly, we've come back down. We bottomed at a little over 10,000, and we've had a nice rally up into the 200-day moving average, which is still sloping down, and we've pulled back the last 2 weeks. The quality of this rally was good, had good breadth. We saw a number of growth stocks that are starting to show leadership characteristics, but there's not many of them. It's still kind of sparse, but the rally itself had some good qualities to it. So the internals. This is a chart, a market breadth chart, looking at the S&P 500, and it's looking at the percentage of stocks that are above the 50-day moving average. And the key message of the chart is the 90% level. When you get 90% of the S&P above the 50-day on a breadth thrust, it's rare, it's unusual. You can see them marked on this chart, long-term chart for the last 12 years. This chart here is showing that we were close to one on August 11th. We subsequently had one of these. And it's important to note when you get these kinds of rare signals. So here's the same chart in a different format, S&P above the 50-day. On August 16th, we actually got to 92% above the 50-day before we started the pullback. You'll notice that the last couple times this happened was April of 21, June 2020, and February of 19. They were all coming out of bear markets. Now, I did find some interesting data from Shivako Capital Research. And in this situation, with this breadth thrust coming out of a bear market, 72% of the time after the thrust, the drawdown, an average drawdown was less than 6%. We are currently, with today's downside action, are now off 8%. So the other thing that was important about the Shivako research was 93% of the time, once you get this kind of thrust above the 90% level, the low for that bear market was in. So that's promising 93% of the time, but we still will take it day by day. So bear market rallies, if you didn't see the national meetup on IBD, I'm going to build off that a little closer on this video. So here we are with the daily NASDAQ chart, and I've marked some levels. 3% pullback, 5% would got us down to the 21-day EMA. And today, as I mentioned, we're off 8%. A 9% decline would put us right about at the 50-day moving average, which will be a really good test to see if this market can hold. The 50-day is actually sloping up, but the 200-day is still sloping down. This is a chart of the NASDAQ showing the stocks that have been breaking out over the last 2 months. I covered this in more detail at the national meetup, but the breadth was pretty good. We had a couple of eureka thrusts, and the power trend is on. My August 12th video will give you more detail about defining the eureka thrust and the power trend if you're interested in those details. So let's go into a couple of bear markets, and I want to look at some specific things. Last time we talked about specifically the zone between the 50-day and the 200-day when you get this rally. And in 1990, we had a rally all the way up to about the 200-day. But then let's look specifically at the decline. The 1990 bottom, there was a decline of about 7.4%, and it was pretty sharp. It was in 4 weeks. Ultimately, that was a retest. It turned around, the market turned around. It actually had a follow-through day, and the market was off on its a bull run. And you'll notice in this case that the retest was 3 months after the original low in October. So the 2003 bottom, there were multiple rallies up into the 200-day moving average. The first one quickly got turned away in a 13% decline over 4 weeks. Then it tried to get through the 200-day again, and then it came and declined further, with the complete decline being almost 17.6%. And that retest, it held the lows from October, but it was 5 months after the low. And the third is the 1962 bottom. The rally only got halfway between the 50-day and the 200-day, and it had an 11.7% decline. It was a slow grind. It took over 8 weeks to slowly pull back, and it was ultimately that test held above the low from June, and 4 months later, and the stock market took a rally from that point forward. So we're in the situation now where this is an up-to-date chart as of today. We can see today with the hawkish Fed comments, we had a very poor day in the market. And, we talked about a couple scenarios. The green line represented a scenario that, maybe we turn around and we shake it off and we move and get above the 200-day. The retest scenario is in light blue, which says that we do grind down a bit and have a more thorough retest that would happen sometime in the fall, and then possibly turning around and a bull market continuing. And the third is the worst. If things really turn bad, we might just break the 50-day in a convincing way and maybe break the ultimate low that we saw in June, and maybe we go to a third leg lower in the bear market. We're still in a bear market. There are signs that things are turning, but we don't know for sure how this retest will turn out. I talked about the psychology of a retest. It even affects the pros. Many people who held stocks are damaged mentally from the capital they lost or are still holding losses. We mentioned that the first significant rally is going to be perceived as a bear market rally, and even institutions will be scared to buy. But we might get this pullback that we've talked about, which we certainly have started now. And the question is, do we get the retest that holds? This is really where the rubber meets the road. Any pros that missed the initial rally, it's going to be important to see if they step in to buy and support the market, or does everybody really feel they're going to sell stock and keep distributing stock, and we begin a more convincing leg down in the bear market. So how would growth stocks possibly look like and set up in these scenarios? I'm going to reinforce one of the ones I covered in the previous video. This is the NASDAQ 2003 bottom, and I've categorized stocks setting up in 2 ways, type 1 and type 2. Type 1 are leading stocks that are breaking out during this initial thrust through the 50-day up to the 200-day. Leading stocks break out. Type 2 are stocks that need more time. They actually are names that are starting to set up, they're basing, and then what happens is once they've based out, we get the retest and we probably get another thrust higher with a follow-through day. Those type 2 stocks could potentially become leading stocks. And you'll notice in this 2003 test, eBay was one of the type 1 stocks, and here's a cluster of them here that became type 2. So let's look at eBay a little closer because I think it's a great example. eBay formed a double bottom base, and you'll notice right off the lows in October, eBay broke out. And you'll notice that in that initial thrust in the market, eBay was moving up as a leading stock, and it was showing superior relative strength. Then in the yellow zone is that multi-leg pullback that occurred in the market. And that was the time when we had the retest. And you'll notice that eBay continued to grind higher, which was showing strength. It wasn't straight up, but it was still moving higher. And then when we got the retest, had another follow-through day in March of 2003, eBay really took off and it was a real leading stock. So I want to switch to the 1990 bottom, and we're going to take a look at a type 2 stock, and we're going to look at Home Depot. So type 2 stocks, you'll notice when the market made its low in 1990, we had a follow-through day, which I've marked in red. You can see the chart of Home Depot is showing that that stock was still basing when the initial follow-through day occurred. As the rally made its way between the 50 and the 200, it got turned away, and we saw that it makes a 7% decline in the averages. And you'll notice that decline right here in the averages is exactly when the handle part formed in the eBay or in the Home Depot base. The handle, that drift down, was right as the market was pulling in. Then we got a good follow-through day in January of 1991, and you see that Home Depot broke out. It was set up properly in a quality base, and it went on a major advance. So there's the looking at how that sideways action down in the market and the handle forming. So let's look at 2022 in this retest scenario that I'm outlining. Again, there's some of the leading stocks that have broken out. The red line here that I've squiggled on here is showing that, we could grind down here in September and October perhaps and form a retest of the low without undercutting the June lows. That's a scenario that I think could play out. Only I'm suggesting that is because the thrust in here was so strong, and it was a pretty quality breadth behind it. But let's see what happens. So two stocks that certainly come to mind as type 1 that have already broken out to new highs are Enphase and Shockwave. Both of them have very strong earnings and sales, and they have strong forecasts for 2023. You'll notice that the charts on a weekly basis here shows Enphase has massive skyscraper blue volume, had a big gap up on earnings, and is acting really well, even though the market is pulling in. That's noteworthy. Shockwave, similar, had a great earnings reaction. You can see a blue skyscraper of a couple of weeks ago. And Shockwave also is resisting this pullback and has not given back much of its gains at all, which is usually the qualities you'll see in a leading stock. So some of the names that might be type 2s that I threw out a couple weeks ago were Star Surgical, Palo Alto, and Palo Alto actually this week had a earnings gap up, so that might be a catalyst for it to get higher up in its base, to maybe get it to base out, to advance as a type 2 name. Tesla is working on a deeper base. Global Foundries is interesting in the semiconductor space. It's a new issue, a recent issue that is acting very well with some volume. Paylocity had a nice earnings reaction gap up as well. So there's some names to kind of, you might want to look into further and watch how they react in this pullback. So one of the things that's important when these deeper bases, when you see deep bases in a bear market, I always want to see a prior uptrend, and Bill O'Neill would always emphasize you need a prior uptrend before building a base. It's a very important quality that you shouldn't overlook. And when I did my study of the 55 greatest winners, I looked at the prior uptrend of these winners. And this is actually a graphic about some of the key insights about prior uptrends. So a prior uptrend, really should be a good 20 to 30% move before the stock sets up a base. Now, in the research I did on the greatest winners, 40% of the biggest winners had a prior uptrend of 75% minimum before they broke out and made a major move. So the prior uptrend confirms that institutions are already buying your stock. And as I mentioned here, you want to be fishing in a pond with the big fish, and the institutions are buying. You want to follow their footsteps. Now, interesting to note, 22 stocks out of the 55 had a 75% minimum uptrend. And what was important is, sometimes you can look at these uptrends and say, I'm afraid to buy the stock. It's already doubled or it's tripled. And the lesson here is don't be intimidated. If a stock has a solid uptrend, it could be a double or a triple. But if it sets up in a quality base that's 6-7 weeks long, you can buy that stock if it breaks out. And the interesting part was even the balance of the study had a prior uptrend of 44%. So the message is, if you were afraid to buy a stock that had already run up 40%, you really missed all of the greatest winning stocks from 2003 to 2020. Now, some of the groups that are acting well, and I'll say these are growth related groups, are certainly solar has been strong, alternative energy has some good names in it, medical systems and equipment, biomedical stocks have been doing well. There's a number of the telecom groups that have been actually doing well. I haven't mentioned energy, but energy is now starting to reemerge as a leading sector. The XLE, the XOP, the oil explorers, the fertilizers have all been basing for a while, and they're now, some of them are breaking out to new highs, and other ones are still completing their bases. So you should keep an eye on them too, while also looking at some of the growth groups which are still emerging. So I've taken a shot at putting together I'll call it a watch list of what I'm calling potential type 1 growth stocks. And these are the stocks that have shown exceptional strength, kind of like the eBay example I showed you, and they're kind of already up and out. They've already broken out to new highs in this bear market. CellH, Shockwave, Enphase, Lantheus, Impinj, On Semiconductor, Montauk, and Ara. So these are some names that would probably fit in that quality of type 1. Now the type 2 names, as I mentioned, these are stocks still forming bases, or they've really pushed high off the bottom and come straight up off the bottom, and they need to digest in order to complete their bases, or maybe form a flat base of 5 weeks or 6 weeks. So these are strong names that you should keep your eye on as we experience this pullback and potential retest. Array, Global Foundries, Tesla, Star Surgical, Paylocity, Wolf, a number of good stocks here that are acting well, but they seem to need more time. If you're a position trader, I am sure within this group of names, if you're a day trader, there's a trade. But I am a position trader, so I'm looking at these to form some digestion before the market gets set up again. So what's always important is to watch your average cost. So I have a couple of simple diagrams here, because watching your average cost is very important. If you buy a stock at 100 and it goes up 20% to 120, let's assume that the market and your stock is going to come back 10% in this pullback, this retest. That would bring the stock back to 108. So you could probably withstand and hold your stock if you bought right and you got into the stock at 100. You could withstand this pullback because you were positioned in a good place. If you chased the stock, let's say in this second example, you bought at 110 and chased the stock not at the pivot point, and the stock goes to 120 and we get the same pullback, you'll see that you're underwater. You're going to end up, your stop's probably going to get hit, and you're going to get knocked out of the stock because your average cost is just too high. You won't be able to hold. And the third example is if you buy the stock properly at 100, but you get excited and you buy more stock and double the position size at 116, you'll have an average cost of about 108. But again, in the same pullback, you're going to be under pressure because the stock's going to come all the way back to break even. You're probably not likely to be able to hold through that. So you have to really, really watch your average cost like a hawk. So if you were in some of these type 1 stocks and you were able to get positioned in some of these, CellH or Enphase, you probably can withstand this pullback we might experience in the retest. If you're out of position, you're probably going to have to sell some stock. I know I closed a couple positions today at small profits, only because I know that they were in positions that were just not going to be able to withstand a more significant drawdown. So I exited for small profits while holding my Shockwave position that has a bigger cushion. So it's important to be flexible. We've talked about the 3 scenarios. Who knows what's going to happen? We don't know, but all we could do is take it day by day. We do know that September is usually a seasonally very, very weak market. performance. So, this retest, we could come down quite a bit here in September. So it's a weak time for the market. Just be open to what could happen. And I'm going to leave you with this slide here, which is really an oil tanker. And, my point is it takes a real lot of energy to turn an oil tanker like this. I do think there's some signs that the institutional tanker turn is underway, but it's going to take more time. Many times I've mentioned with historical precedents, this retest coming off a bear market low could take 3-4 months. We're only barely 2 months into this. So it's going to take some time, but keep your eyes, your watch list fresh, and watch how stocks act on this pullback. It'll be very revealing if this is going to hold up or if things are going to completely roll over. That's all I have time for now. Again, join me on Twitter, subscribe to my channel, and we'll see you at the next general market update.